If you've locked in a 2 or 3% rate during COVID, you've probably got two things right now. A lot of equity you've built up and a pile of non-mortgage debt you'd like to deal with. And somewhere along the way, someone told you your choices were to keep the rate and figure out the debt on your own, or give up the rate, cash out, and start fresh at today's number. That's not the full picture. And if someone has mentioned a HELOC to you, you're closer, but most homeowners have never heard of the other product. And that gap in the conversations costs people real money. Hi, I'm Wade Betz, Chief Strategy Officer at Empire Financial in Dallas, Texas, with 20 years in the business. I have this exact conversation regularly. Homeowners calling me about their equity, dreading the idea of touching their interest rate, asking what they can actually do. And I want to be clear right up front. This isn't about convincing you to give up your rate. For a lot of you, the whole point is that you don't have to. Right now, the prime rate is sitting at 6.75%. Credit card balances are at record levels, and if you bought or refinanced between 2020 and 2022, the average homeowner is sitting on about $303,000 in home equity. So today I'm going to walk you through what I call the second lien decision, what a HELOC is, what a HELOAN is, and who each one is built for, and a Texas-specific rule that disqualifies some of you before you even apply. A HELOC is the most flexible way to access your equity. It's also the most expensive way to hold debt for the long term. HELOC stands for Home Equity Line of Credit, and that name tells you exactly what it is. It is an open-ended line of credit secured by your property. You can draw from it, pay it down, and draw from it again as many times as you want up to your limit. So think of it like as a credit card, just one that's secured by your house. The interest rate is variable, which means it moves with the market. Specifically, it's tied to the prime rate plus a margin, and that margin differs from one lender to the next. With the prime rate at 6.75% right now, most HELOCs are landing somewhere in the 8s or 9s, depending on your lender and your credit profile. Now, here's the part that people miss. Most HELOCs start with an interest-only period, usually somewhere between 5 and 10 years. And that sounds attractive because the payment feels low, but that's not a discount. It's a delay, and you're not paying anything towards what you've borrowed. You're paying to rent the money. And once that interest-only period ends, you start having to repay principal and interest on the full balance, which means your payment goes up sometimes significantly, and you're still on a variable rate while that happens. The best use case I see for HELOCs is a real estate investor, someone who uses their home equity to fund a fix and flip, sells the property within 3 to 6 months, and pays the line back down. That's the product doing exactly what it's designed to do. Short-term, high fluidity, in and out. The worst use case is someone who takes out a HELOC to put in like a pool and then makes payments on it for the next 15 years. By the time they're done, that pool costs them significantly more in interest than they ever imagined on a rate that was moving the entire time. So ask yourself one question before you choose a HELOC. How long am I actually going to carry this balance? If the honest answer is more than 2 years, you're already looking at the wrong product, because here's what most loan officers never bring up in this conversation. There's a second product that changes the math entirely for people who need to hold the debt long term. A HELOAN is a fixed-rate second mortgage. For long-term needs, it wins almost every time, and most homeowners have never even heard of it. HELOAN stands for Home Equity Loan, and it's on the other side of this conversation. It's closed-end credit, which means you borrow a specific amount at closing and you get a fixed interest rate, and you pay it in equal monthly installments for the life of the loan. Terms are typically 10, 15, 20, or 30 years, and from day one, you're paying principal and interest. Here's the number that surprises people when I show them the comparison. The HELOAN rate, because it's fixed, is meaningfully lower than what you'd get on a HELOC right now. So even though you're paying principal and interest from the very first payment, the actual dollar amount each month is often within a few dollars of what you'd pay on a HELOC during the interest-only period. So you're reducing your balance from day one, and your payment is the same. That rate difference alone is doing the work. So think of the HELOAN as a second mortgage, because that's exactly what it is. Your first lien stays exactly where it is, you're not touching the rate, and behind it sits a fixed rate loan with a payment that doesn't move regardless of what happens in the market. So for someone trying to consolidate $35,000 or $40,000 in credit card debt running at 21% interest, this is a completely different conversation than a variable rate line. A HELOAN gives you a predictable number you can budget around for the next 10 or 15 years. No surprises, no adjustments, same payment every month. If the thing you're paying for will still be in your life 2, 5, 10 years from now, the HELOAN is probably where you need to be. When you talk to a lender about equity options, ask specifically about HELOAN products. Don't let the conversation end at, here's what our HELOC looks like. Ask what a fixed rate second would cost you at 10, 15, and 20 years, and then compare the total interest paid on both options over your expected payoff timeline. The math usually answers the question for you. So which one is right for your situation? I want to give you a simple framework for that. But first, I put together a free one-page guide called the Second Lien Decision Guide. It's a side-by-side breakdown of HELOC versus HELOAN, the questions to ask your lender, and a simple timeline calculator to figure out which product fits your situation before you sit down with anyone. The link is in the description. Go and grab it. It'll make whatever conversation you have next a lot more productive. Okay, back to it. The choice between a HELOC and a HELOAN comes down to one question. How long will you carry this debt? Answer that and the right product follows. Here's how I think about it. A HELOC is chess. You're making short moves, staying fluid, reacting to the board. A HELOAN is checkers. You set your position at the start and you move in a straight line. Neither one is smarter than the other, but they're built for different games. Two scenarios. Scenario one, a real estate investor who wants to pull equity to fund a down payment on a rental property while they get a DSCR loan in place. Use short-term use, clear exit. The HELOC makes sense. Scenario two, a homeowner who's been carrying $40,000 in credit card debt and wants a predictable payment to get it paid off over the next 10 years. That's a long-term obligation. The HELOAN wins. If you don't have a clear answer on your timeline, you're not ready to choose a product yet, and that's fine. That's exactly what the conversation with your loan officer is for. Before you apply for anything, get 3 things on paper: what you're borrowing for, how long you'll realistically hold the balance, and what you're going to do to make sure you don't reaccumulate the debt you're paying off. That third one matters more than most people give it credit for. Tapping your home equity to wipe out credit card debt and then running the cards back up puts you in a worse place than where you started. Now I need to cover one more thing. And if you're in Texas, this one could disqualify you before you even pick up the phone. Texas law allows only one equity loan secured by your home at a time. If your existing mortgage is already an equity loan, HELOC or HELOAN is not available to you. This comes directly from Article 16, Section 5A6K of the Texas Constitution, which states that only one loan under that section may be secured by your home at any given time. In practice, that means if you refinanced your home in Texas and took cash out, that transaction is classified as a Texas 50 equity loan, and you cannot layer a second equity loan, whether that's a HELOC or a HELOAN on top of it. Texas is the only state in the country with this restriction. Anywhere else, what I just described is a straightforward second lien situation. Here, it's a constitutional stop sign, and it's not a lender policy we can work around. It's in the Texas state constitution. I get these calls regularly. Someone refinanced in 2021, lowered their rate, pulled some cash out, and now they want a HELOC to go fund a home renovation or knock out some debt. And I have to tell them they're not eligible for a second lien equity loan in Texas because their first lien is already an equity loan. In that situation, if tapping equity is still the goal, we're talking about a full-fledged cash out refinance, which means touching the rate that they've been trying to protect. If you're in Texas and your current mortgage involved a cash out, stop before you apply anywhere. Find out whether your first lien is classified as a Texas 50 equity loan. That single question changes the entire conversation. And here's what I tell people honestly when they're in that situation. Yes, giving up a 2.5% or 3% rate is a real cost. But if you're carrying significant high interest debt, sometimes the math of what the debt costs you each month still makes the cash out refinance the right move. Reshuffling your debts, even if it means getting rid of that low rate, can do more for your household cash flow than holding that rate while you pay 21% on a credit card. Just have a plan to not reaccumulate the debt afterwards. That part's on you. If any of this applies to your situation, whether you're trying to figure out which product is right for you or you're in Texas and you're not sure what your first lien is classified as, use the link below to book a call with my team. These conversations are most useful before you've made any decisions and there's still time to look at your actual numbers without any pressure. If you want clear explanations of how your mortgage and your home equity actually work and you'd rather hear it straight than piece it together across 3 different Google searches, make sure to hit subscribe. That's what we're building here. Next, watch the one I did on loan estimates. So if you're going to be shopping HELOCs or HELOANs across lenders, that video will show you how to use every estimate you receive as a negotiation tool, not just paperwork to skim and sign. My goal is to help you make informed decisions with confidence and ultimately win with Wade.